Hi, welcome to today's video and thanks for joining me. Today we're going to be answering these questions, 10 steps you need to take before you retire. Now this is more of a checklist, nothing to print off here, but you could just take out a piece of paper to take some notes because I think you're going to find it valuable. And we're also going to be talking about mortgages right now because that is one of the biggest problems that people are facing right now is that cash flow problem that you have right now. So I'm going to be addressing that. So if you're in that situation, stick around because you're going to like this. If you're new to this channel, thanks for tuning in today. My name is David and I'm an active advisor working with individuals, families, and business owners right across Canada. I do their financial plans, I invest their money, I'm life licensed, so I do life insurance. And I'm also helping business owners by teaching them how to take money from their company without paying any income tax. I love what I do. I think it comes across in these videos. I make them for not just for your enjoyment, but for your knowledge, because when you have more information, it leads to better questions. And better questions always lead to better outcomes. So welcome and thanks for tuning in. Remember to hit that like button and put your comments below because I like to hear what you have to say about the videos. Well, let's get into why you're here today with step number one. I want you to visualize your retirement. I know it sounds kind of weird because you're saying, I've been looking forward to retiring. I know what I'm going to do. I don't need that. Some people do. Some people need to know what they're going to do. But what I want you to do is look beyond that first month, look beyond that first 6 months of your retirement, because it's this routine that a new routine that you've developed. It could be a very exciting routine. I hope that it is. But what I want you to see is this idea that you have a routine with your work, and we define our lives by who we are and the occupation that we have. And our routine is kind of built into that. And this get up, shower, figure out what to wear, like that by itself is mind-boggling for people every day. Like, what am I going to wear on Monday? I can't wear the same thing I wore on Monday. I got to wear something new on. Like, that doesn't have to be that way when you're retired. If you want to be in your pajamas all day long, go for it. So that whole routine, just that simple routine, is going to change. But what I want you to do is visualize way past that. And that is when you actually get past this idea that you are retired and that you don't have to get up by a certain time and that your time is now yours. So what are you actually going to do? How are you going to live that life, get excited? What's going to get you fired up? And visualize what you're going to be doing with yourself. Because part of that, of not doing that, bad habits can set in. Bad health choices can set in. Not developing the kind of network you might need to be able to have good quality relationships. Remember, you're not going back to work again. Some of those relationships, you're never going to see these people again. Some are lifelong friends, but many of them you're probably not going to associate with again. So it's all about you visualizing who you are going to be in retirement, who's going to be around you, and what are you going to get excited about. So take time to visualize what that looks like. But here are 4 questions that help you figure that out. When do you want to retire? Some people say, I have no idea, maybe 1 year. I hope you've figured this out before if you're 1 year away. Is it 2 years, 5 years, 10 years? So do you have enough money to retire? Number one question is, will I have enough money to retire? You need to talk to an advisor about what's your deposit schedule, what's your withdrawal strategy, what's retirement going to look like, where's the money going to come from? You need to get ready for this because that time's going to go by that fast. How do you want to retire? Do you want to phase yourself in, work part-time a little bit, and then go into full retirement, or just full stop? Where do you want to retire? Are you going to live in the same house? Are you going to downsize, move to the condo? Are you going to move to your cottage or buy a cottage? Are you going to live in a more rural area? Or are you going to move right down into the city into a condo where you can just come down the elevator and go conveniently to different places? Are you going to live in a different country, different province? What are the tax rates in these provinces? What's the healthcare look like? What's the healthcare look like in different countries? Canada has tax treaties with, I think, about 100 different countries. So, I mean, these are big questions for a lot of people. What are your retirement goals? Are you going to travel the world? Are you going to start a new business? Are you going to get involved in the community? Like, what is that you want to do with your time? So there are 4 questions. Those are 4 big questions that you got to solve before retirement. Step number 2, get a financial plan. Surprise, surprise, it's in every video that I make. Doing financial plans for people is one of the great joys of my profession. I get to see people relaxed, confident, grateful. I mean, I get a lot of people who are just showing gratitude about what having a financial plan is doing to them mentally, emotionally. They just are totally relaxed. They have the questions. When I first talk to people about financial plans, they have dozens of questions about planning. I said, just do a plan and those questions disappear. Like, really, that's what the plan will do for you, because it's going to allow you to see your planning outcomes before you commit to them. When to take CPP, how to do a RIF meltdown if you need to do a RIF meltdown, what your tax rates will look like, building in vacation expenses, buying a car every 5 to 7 years, downsizing your house, and what that looks like for taxation in terms of which accounts it goes into, making sure your estate values are as big as you can, making sure they go to the right people, paying less tax to Revenue Canada. Like, all these things are really important to do, so get them done. Step number 3, eliminate debt. I'm going to take just a minute here to talk about this, because this is the hot button right now. 2023, people are being crushed by debt. This might be one of you. So you, over the last, 2020, 2021, people were taking advantage of their homes going up in value and borrowing against their homes, leveraging to acquire income producing assets. And of all the debt, a third of all the mortgages right now in Canada are all variable rate mortgages, and 3/4 of those mortgages are fixed rate mortgages. And so what happens when someone's on a fixed rate mortgage is your payment doesn't go up if you have a fixed rate, but what happens is the amount of money that is going towards your principal is diminishing. When you look at, here's this chart on fixed rate mortgages, you see a lot of people now are in this trigger rate. This is what's called a trigger rate, is when your interest charges are now greater than the actual payment amount, and no more of your money is going towards the principal. It's all going towards interest. You can see in this chart, top right hand corner, where the interest rate goes above that principal amount, and now you're paying money every single month on interest, you're not paying down your debt anymore. And if you're someone who is in the rental market where you've acquired rental properties, it's unlikely that your rent is now covering the interest charges. So you have a big decision in your mind. Get with a financial advisor. Get with an advisor that can do a plan. Doesn't have to be a financial advisor, just an advisor that has experience doing plans and doing planning, and you trust and knows exactly how to do these kinds of plans. This is important for you to calculate whether or not you can sustain the next 2 years. Canada just raised interest rates. They're probably going to raise interest rates again this fall. Same with the United States. So interest rates are not going to go down anytime soon. I would budget to have high interest rates for the next 2 years. So to have this problem for the next 2 years, and to figure out whether or not you can sustain it. Now, you took the decision to take leverage on your own home to buy rental property because it may have been part of your retirement plan. That at some point you might be using the rental income as to fund your lifestyle, or to sell the property and then push that money into your portfolio to give your lifestyle some added income. So if that was part of your retirement strategy, talk with your advisor, figure out whether you can sustain this for the next 2 years, because after that you're going to see that you're able to have more moderate mortgage rates, and things will go back to being more normal interest charges. Is that something that you need to figure out? Absolutely, 100%, because this is devastating for a lot of people right now. So I would say to you, talk with an advisor, get a plan done, and then you'll be able to figure that out. Number 4, have regular reporting and regular reviews with your advisor. When you do a plan, you're going to you can see this chart here. This is everywhere you could have invested money. So when you look at this, I know they call this actually a quilt. JP Morgan puts this out, and they call it their quilt. And it's essentially all the different areas of where you could be investing your money. So the allocation of where you put your money, whether you're putting into large cap or REITs or small cap or fixed income. So if many of you who are near retirement or going into retirement will have fixed income and some equities. But this tells you where you could put your money. I'm not going to get into what's the asset allocation over or not, or a 60-40. That's not what I want to talk to you about. What I really want to talk to you about is this idea of getting regular portfolio reviews and talking with your advisor. Increase the communication with your advisor during periods of real market volatility, rising interest rates. Like, make sure you're having regular communication with your advisor to know exactly what you're invested in and that you're not going to be in any danger. More and more often, I do portfolio reviews for people, and I see that they're not invested properly, or they're spread way too thin. They have so many positions for a small amount of money, or they have 3 positions for a lot of money, or they're overweighted, meaning they're being invested in one category versus spreading out in being more diverse. And I think it's important that you get a portfolio review done with someone who manages money at the account size that you're at. So be careful when you interview advisors. Not all advisors are the same. They don't all work in the same markets. They don't all invest in the same kind of products. Some are very comfortable taking lower dollar values, working with families, with young children, and some are in the retired market working with people who are near retirement and retired. So they tend to work with higher dollar amounts. So make sure you're talking to the right person. Sequence of returns, I'll just take a quick note here, because these are in other videos that I've got to talk about how to manage your money. But sequence of returns, just an interesting thing here. If you look at somebody who, the same dollar amount, and you go 10 years, so a fixed rate, you see that solid blue line, 4.8% all the way through retirement. They end up having $537,000, okay? So it gives you some insight as to what happens when somebody invests their money at fixed rate. And now let's compare what happens if somebody had 2 years of positive returns in the first 2 years versus somebody that got 2 negative years in retirement, the first 2 years. So the person who has 2 positive years and then has their average return across, still, the average return in all 3 of these lines is 4.8%, okay? The one that started off with 2 positive years has $586,000, more than the person that had a straight line 4.86% or 4.8%. The person that started off with 2 negative returns in their first 2 years and still had 4.8% throughout their 10 years had $472,000. So the sequence of returns matters. This is why it's important that when you actually invest your money and talk to an advisor about how your money is managed. Ray Dalio had this unbelievable video. I encourage you to look it up. Go on YouTube and just type in Ray Dalio uncorrelated portfolio, and you're going to see this chart. And really what he talks about is making sure that your investments, so what you're invested in, I don't care whether you're in stocks, bonds, mutual funds, segregated funds, whatever you're invested in, is making sure that whatever position you have here is not correlated or the least amount of correlation. So you don't want if you have let's say a fund that invests in energy company, and then you get another fund that invests in the same energy companies, then that is a heavily weighted or heavily correlated portfolio. You can see what happens on the right-hand side. As you have highly correlated portfolios, the risk of losing more of your money increases. So you want to have uncorrelated investments. So if you have one investment, it's going to provide this income return stream. Then you have another investment that's going to have completely uncorrelated as much as possible to the previous investment. That way, if one goes down, whatever the risk is on that one going negative, doesn't allow this one to react the same or to the extent of the other ones. That's what's an uncorrelated portfolio. So you go through that exercise with your advisor to try to minimize the correlation in your portfolio, and that way you'll actually have, in times of market volatility, your portfolio will not go down as much because you have uncorrelated assets, okay? When to start CPP and old age security. One of the biggest questions I get all the time is, when should I start my CPP? Not so much about old age security, but when should I start CPP? And the way that you do that is you get a financial plan. And when I share people this retirement timeline, you've probably seen this in some of my other videos, early retirement is at 60 people who worked for the government and police and like provincial, federal employees might be able to retire. Often teachers retire before 60, and you really don't have access to CPP until age 60. So that's the earliest age. And then 100% of your CPP begins at age 65, and so does old age security. So there might be a gap of when you are thinking of taking CPP and when you're retiring, there might be a gap that you need to fill in terms of income. Where is that money going to come from? What part of your portfolio is going to supply you with that gap until CPP starts? So taking CPP early or delaying it is really a question of where you are on this timeline, how old you are, how old you think you're going to live, and how much money you need. And so it's important for you to consider these things when you go into retirement, having an advisor talk to you about this. The maximum benefit you get from CPP at age 65 right now is just over $1,300. Most people don't get that. Most people get somewhere between $700 and $800 a year, depending largely on how many years they were actually contributing the maximum into their CPP, and if they actually take it at 65 versus early. If you take it early, you're actually penalized. You can see here for every year you take CPP early, you subtract 1306 by 7.2% for each year that you take it early to age 60. And then conversely, if you decide to delay, you get a bonus, so you get more money. When you look at the break-even analysis that I've got a video here that talks about break-even analysis. That just shows you what happens if you were to take it at 60 with the blue line versus 65 in the red line, and taking it at age 70 with the yellow line. Where does the one income stream of CPP going up with inflation intersect with taking it at the other ages? So you can see around about 71, 72 is the difference between 60 and 65 versus taking it, delaying it. If you delay at age 70, then by 77, roughly, this is where you would actually intersect if you had taken it at age 60. And then around about 81 is when it would overtake had you taken it at age 65. So this is why people, when I've said in other videos, like, how long do you plan to live? It's not like you deciding when you're going to pass, but what's the longevity in your family look like? Because delaying it till age 70, you're going to have the same amount of income up until about age 81 if you had taken it at 65. So how much longer are you going to be living? So this is important for you to understand how CPP works if you delay. Employer pensions. If you're lucky enough to have a defined benefit pension plan, you want to actually look at a couple of things before you retire. So you want to know what your commuted value would be if you're going to retire, so you can make the decision whether you want to commute your pension or keep the income stream, keep the pension. You get a financial plan that will give you all those calculations. Then you're going to look at taxation, the difference between taking a commuted value versus keeping your pension, and also what that does for your estate values if you were to commute your pension versus keeping your pension. And then health benefits. Of course, if you commute your pension, it's unlikely that you'll have any health benefits. Step number 7, tax efficient retirement plan. When you have a tax efficient retirement plan, you start looking at income splitting, pension splitting, maxing your tax-free savings account, making sure you're putting money into your tax-free savings account so you're not being taxed on that, especially any of your portfolio, your non-registered portfolio that might produce an income to you, put it in a tax-free savings account so that you're not having to actually pay tax on that. Applying for the pension income tax credit, and then finding out the taxation of what happens if you want to choose living in a different country. All these things you would want to look at if you've got a defined benefit plan especially. And where do you want to live in retirement is going to be the next step. So let's answer these questions. That'll help you to figure out about living abroad. Do you plan to continue living in your current residence in retirement? So same kind of question. Or are you going to downsize, move in a condo, or go live in a different province or different country? Are you downsizing and buying a smaller home or renting? Again, a financial plan shows you what happens when you downsize, where the money goes, into which accounts. And then if you want to build in that you're going to take some of that money and buy a small condo or rent, All of that can go into a plan ahead of time so you can make the decision about what's going to happen in 25 years or 20 years or 15 years. Are you planning to live abroad in a sunnier and a cheaper climate? Forgot the T there. Oh, wow, that sounds appealing, right? But it could be beneficial, but what happens if you get sick in a different place? What are your health benefits? What are your health options then? And what is the taxation? And what's the cost to live? And what does it cost to buy groceries and so on? Is your home going to provide a significant portion of your retirement income? My financial dashboard that I gave everybody, if you are interested in getting a sample of that, just put your comments below and I'll send one to you. It's just a PDF document. But what it does is it shares with you right in the middle of the document all your assets in a pie chart. And it visually gives you some indication as to which of your assets are you really going to rely on in retirement. And if you see that your home value is well over more than half of all of your assets, it's probably a good indication that you're going to need your home in retirement. So let's start building that into your plan, how to use your home in retirement. Do you plan to get a reverse mortgage? I actually build that model into some scenarios. So looking at a financial plan and saying, what if you started to do a reverse mortgage or just did lines of credit against your home to supply you with an income stream so that you can stay in your home as long as you possibly can and then sell your home later? What are the costs of a retirement home or in-home assistance? So this is more of understanding as we age, if you do have any health issues, how are you going to live in the home that you're in? Would you need to make any changes to like physical changes to the home so you can remain in the home? How much is that going to cost? Where is that money going to come from? And where's the support you're going to require? So being able to somebody come to your home or maybe driving you to see your medical appointments, that kind of thing. So you got to figure that out ahead of time. And if you're planning on being overseas, what would that look like too? We're almost there. Step number 9. How am I doing so far, by the way? Put your comments below. Hit that like button. I want to see your comments and hear from you, okay? So life insurance. How do you view life insurance? I'm not going to go in depth on this. You can watch this video right here and that'll teach you all about it. But let's take a minute and I'll show you how I use life insurance with many of my clients to maximize their estate values, to grow money in a tax-free environment, and then to be able to leverage that later to produce an income stream, tax-free income stream. On the left-hand side, the left box, that's a non-registered investment portfolio, depositing $1,000 a month for 20 years. It's $240,000 over 20 years. That gets invested. They pay tax on the growth of that money, and then you're going to pull it out, let's say over a 15-year period when you retire. And in that period of time, you're going to pull out almost $490,000 of after-tax income. And then person, let's say, dies at age 86, like average age of mortality in Canada, and they've totally expired that account. Okay, let's look at life insurance, same thing. $1,000 a month, $240,000 a year into life insurance, whole life insurance. And in this case, we're talking about participating whole life insurance. We're not talking about universal life insurance. This is not a good idea to use universal life in this strategy. So if anybody said to you, oh, we'll use universal life, you may want to reconsider that. I'm not saying it's a bad product, it's just for what I'm talking about, it's not the right solution. So whole life insurance or permanent life insurance. So the money gets deposited in insurance, it grows on a tax-free basis. So it gets, let's say, over the years I've been doing this, 4.5% to 8% rate of return. So take the midpoint, if you like, 5%, 6%. And it gets that rate of return, and you don't pay any income tax on the growth. So you don't have to report that to Revenue Canada. The money stays inside the policy and compounds on itself. So it grows a little bit bigger than you would have in a non-registered plan. And so you're able to take over the same period of time, let's say 15 years, just as an example. I'm not saying you have to take it out over a 15-year period. I'm just giving you an example of how this could work. You draw about $550,000, so a little bit more money than the non-registered plan. But when the person passes away, it's life insurance, so there's a death benefit. They use $550,000 more money than they did in the non-registered plan, and $1.3 million goes tax-free to their beneficiaries. So the question is, why would you do the non-registered plan when you could have done the life insurance. So that is how I help clients with a non-registered portfolio. Not all their money, could be some of their money, and just being able to use this as an alternative to the way that they're investing. I hope this is really just making you go, what did I just see? Because it's an interesting concept that you ought to explore if you're healthy. And the last one, what are your estate goals? So do you have a will? Make sure you've gotten a will updated. Many people, get a will and they forget. If you're near retirement or going into retirement, just update your will. Make sure you have a power of attorney. I talked to a recent client and they're talking about, we just got 2 new rental properties. We're buying a 3rd rental property. And I'll say, if something happens to you, is there somebody there that can pay all the bills, pay the taxes on the properties, deal with the tenants? Like, who's going to do that while you're recovering? God forbid if something happens to you. And the answer was nobody. So you need to make sure you get power of attorney to make sure someone makes decisions for you that you can trust so that you can recover and then get back to enjoying your retirement. I would say talk to a life insurance advisor about the benefits of using segregated funds. They're different from mutual funds in the sense that they offer guarantees that you don't get with mutual funds. So talk to somebody about that. Be open-minded about what does it mean? Why are people who are near retirement or people who are like in their 50s and 60s, 70s and 80s, why do they have money in segregated funds? What do they know that I don't know? How to integrate life insurance in your own financial plan. Just ask the question, do we need insurance and how would it help us? If financial plans show you the estate value, say, here's what it looks like with insurance, here's what it looks like without insurance. And then make sure you get an executor planning binder. If you don't know what that means, put your comment below and ask me about it, and I'll send you something that I actually have on my website for your executor. It's a downloadable PDF that you can just print off and then, put it somewhere. My clients actually get a binder that has 8 tabs in it and talks about different ways to get yourself organized. So if you don't have that, give me a message and I'll gladly share that information with you. Well, thanks so much for sticking around today. I really enjoyed sharing this information with you. Remember that we take care of your wealth management so you can take care of what's most important to you. I thoroughly enjoyed sharing this information with you. If you found that it's useful to you, it might be useful to other people too. So share that with people that you love and care about. And remember to come and join me on the next video as well. I have well over 100 videos in my YouTube channel. So figure out which one works for you and which one is going to supply with the knowledge that I spoke of in the very beginning that you need. Thanks so much for tuning in, and I look forward to seeing you in the next video. Take care.